An individual stock, index, or ETF of an index can still use the advanced decline line for the confirmation of a trend. It will usually be in the short term, such as during these key swing points during the larger downtrend, that closely coincide and sync up with the movements of the advanced decline indicator for a short time. This indicator shouldn't be used as a close representation of support and resistance areas or trend lines that relate to price, since even over the short to medium term, there can be drastic differences between the movements of a chart's price and the indicator. Since this indicator is essentially a tool to compare a chart to the rest of the market, an individual chart, even for a stable stock or index, will usually sustain a movement in one direction for much longer than the advanced decline line. This makes sense since the broad market has less potential for volatile movements compared to a single chart, and it would be less common for sharp movements to be sustained across the whole market for even a short time. In this example, the indicator helps confirm the start and continuation of the downtrend at those key points where there is synchronization between sharper drops in price and a sharper decline of the advanced decline line. In the past few weeks, the indicator has risen sharply while price has only begun to go on a more neutral to bullish stance. Though in any case, the general movements for this shift in sentiment can be seen on the price chart and the indicator. The close synchronization of movements that follows helps determine the increased chances of continued moderate uptrend development, which did end up happening. Again, trying to plot support and resistance areas or trend lines on this indicator isn't so useful since close synchronization of movements with a price chart usually won't be sustained for a long time. It is more useful to focus on short-term synchronization of movements